Wall Street is officially replacing human traders with autonomous generative intelligence. In boardroom meetings across New York, London, and Tokyo, the world's largest investment banks are executing a massive structural shift. Human trading desks that once required hundreds of highly paid analysts are being dismantled and compressed into single, hyper-optimized machine learning architectures. This is not a future projection. It is happening right now across global capital markets, driven by a wave of applied generative financial models operating at unprecedented computational scale. Over $92 billion has surged into specialized financial artificial intelligence systems this year alone. Institutional firms are no longer using technology merely as a support tool for human decisions. Instead, they are handing total execution authority to advanced neural networks capable of predicting market shifts before human eyes can even process the raw price action. While retail investors continue to rely on traditional indicators and delayed financial news, institutional capital is flowing through continuous mathematical probability engines that eliminate human emotion completely. The fundamental dynamic of buying and selling asset classes has changed forever. Where human traders once spent hours reading balance sheets and interpreting economic data releases, generative AI models now process billions of data points simultaneously. They ingest macro trends, corporate filings, global trade routes, and order flow dynamics in milliseconds. To survive in this modern financial ecosystem, you must understand the mechanics of this transformation and how institutional funds are using autonomous mathematical models to extract profit from everyday market participants. The iconic image of crowded, chaotic trading floors filled with screaming brokers is officially obsolete. Modern institutional trading floors are quiet rooms filled with server racks and machine learning engineers. Investment banks have realized that human traders possess fatal vulnerabilities: emotional fatigue, cognitive bias, and slow processing speed. A human trader takes several seconds to evaluate an unexpected rate hike or inflation metric. In sharp contrast, a specialized generative model executes complex hedging strategies across thousands of asset classes in under 5 microseconds. Generative artificial intelligence in 2026 goes far beyond simple predictive algorithms. These systems construct dynamic synthetic market environments, simulating millions of potential market crashes, liquidity squeezes, and macroeconomic shocks every single hour. By training on these synthetic scenarios, generative trading agents develop self-correcting execution strategies that adapt instantly to live market stress. When volatility spikes, these agents do not panic or hesitate. They automatically harvest liquidity, while human investors panic sell into falling order books. In addition to synthetic simulation, modern generative agents process unstructured real-world data at massive volume. They continuously monitor global satellite telemetry, tracking shipping container movements at major international ports, energy consumption patterns in industrial hubs, and agricultural output via multispectral imaging. Before an oil company officially reports its quarterly earnings, an institutional AI model has already calculated its production volume and pre-positioned short or long options positions across global derivatives markets, leaving human analysts far behind. Traditional quantitative trading relied on rigid, rule-based algorithms designed by human programmers. If market conditions shifted outside those predefined rules, the algorithm failed. The current revolution is driven by mathematical reasoning agents powered by multimodal artificial intelligence. These advanced reasoning models build their own internal hypotheses about market conditions. They reconfigure their mathematical weights dynamically, discovering non-linear correlations between asset classes that human minds could never identify, such as subtle cross-currency fluctuations predicting commodity price moves hours in advance. Risk management has experienced a complete architectural transformation as well. In traditional finance, Risk officers calculated portfolio exposures at the close of each trading day, adjusting leverage hours after market movements occurred. Generative AI risk engines calculate continuous real-time risk scores across global balance sheets. If a geopolitical event threatens supply chains in Asia, these agents instantly rebalance capital allocation across European equities, American treasuries, and precious metals within fractions of a second, completely insulating institutional balance sheets from unforeseen tail risk events. The result of this technological leap is an immense extraction of market liquidity. Because these reasoning models operate with lower latency and higher statistical accuracy, they consistently front-run human market orders. When a retail trader submits a market order through a standard brokerage app, institutional generative models detect the routing order flow in dark pools, adjust pricing fractions ahead of the execution, and capture the microscopic spread. Accumulated across billions of daily transactions, this algorithmic advantage yields tens of billions in risk-free institutional returns. Most retail investors are playing a game whose rules were rewritten without their knowledge. Standard technical analysis tools, such as basic moving averages, relative strength indicators, and chart patterns, are openly exploited by institutional artificial intelligence. Reasoning models are explicitly trained to detect where retail stop-loss orders accumulate around obvious chart support levels. The AI intentionally drives localized short-term price pressure to trigger these retail stop-loss orders, absorbing cheap liquidity before aggressively pushing the price back in the primary direction. Furthermore, over 60% of institutional equity volume now occurs inside off-exchange venues known as dark pools. Dark pools allow massive financial institutions to trade large blocks of stock without publicly disclosing their order size or execution price to retail markets. Generative financial models orchestrate these dark pool transactions seamlessly, splitting massive buy orders across dozens of private venues simultaneously to avoid moving public stock prices, making true institutional positioning completely invisible on standard public price charts. The information asymmetry gap between retail traders and institutional AI systems has reached historical highs. Retail investors consume financial news through mainstream media outlets and social platforms, receiving information minutes or hours after it occurs. Institutional generative models consume raw, direct-feed API streams, analyzing economic speech transcripts using sentiment analysis neural networks as the words are spoken live. By the time a news headline reaches your phone notification screen, institutional AI systems have already priced in the outcome completely. Despite the massive dominance of institutional capital, the explosion of the applied AI market is finally democratizing advanced tools for individual investors. Powerful retail-accessible generative tools, automated portfolio management platforms, and algorithmic risk software are becoming widely available. Individual investors no longer need to analyze markets manually using outdated spreadsheet models. By leveraging automated AI financial tools, retail investors can deploy dynamic risk management strategies, automated rebalancing models, and institutional-grade portfolio diversification directly from their personal terminals. To protect and expand your capital in an AI-dominated market, your strategy must pivot away from discretionary emotion and towards systematic, automated execution. Successful modern investors utilize AI-driven tools to automate dollar-cost averaging, optimize multi-asset asset allocation, and strictly control downside risk exposure with algorithmic stop parameters. Relying on gut feelings, social media tips, or delayed news commentary is a guaranteed recipe for capital destruction in an environment where hyper-intelligent machines control $92 billion of financial flow. The era of human discretionary trading is officially over, replaced by a hyper-efficient algorithmic grid that never sleeps. Those who adapt to this new paradigm will build resilient wealth, while those who ignore the machine revolution will see their capital systematically absorbed by Wall Street's algorithms. The choice to adapt is yours. Subscribe to stay ahead of the machines.